walk us through these safe harbor rules?
Yes, of course. So the safe harbors, they are transitional safe harbors, and they're based on the country-by-country report. So we have three different safe harbors that you can use. It is the de minimis rule, it is the effective tax rate safe harbor, or it is the routine profit test. And when you can apply one of these safe harbors in a jurisdiction, you don't need to prepare the full globe calculation, so it's much easier. Good to know is that it is the application of the safe harbors, it is based on the country-by-country report. So when you should use the data from your country-by-country report in order to calculate whether the safe harbors apply.
The de minimis rule is for countries where the revenue is less than 10 million euros and the profit is less than 1 million euros. So only for smaller activities of multinational groups.
Okay. Yeah, so that's only for a limited number of jurisdictions then possible, but also when you are bigger in scale in a certain jurisdiction, you can still apply safe harbors. For example, you have the effective tax rate safe harbor. When based on your country-by-country report, your effective tax rate is more than 15% in 2024, then you also meet one of the safe harbors, namely the effective tax rate safe harbor, and then you also do not need to make the whole calculation. One important thing to note is that the effective tax rate safe harbor, the threshold, it will increase gradually. So it will be 16% in 2025 and 17% in 2026.
If that doesn't help, we also have the routine profits test, which means that whenever you have group profits below a certain threshold that consists out of the substance-based income exclusion, then you also meet the transitional safe harbor.
Yeah, that's good to know. And it's based on qualifying payroll and qualifying assets.
Think of the country-by-country report, or CBCR, as your global report card. So it shows data such as revenue, profit, taxes, but also employed
people, etc.
And that's a crucial step, because if you don't meet the CBCR standards, what happens is that you can't apply the safe harbors in your globe information return.
And this is really important, because only then you can lower your Pillar 2 compliance and use the safe harbors.
So what we're saying is you only have a couple of weeks to get this prepared in order to lower the burden for your Pillar 2 compliance. So we advise our clients to start preparing in time, get your systems in check, and then you're prepared well in advance.
So you are absolutely right. Pillar 2 compliance isn't something that you can leave until the last minute. You need to be prepared, and you need to start collecting your data and make sure that your systems are ready.
And besides the administrative burden of the globe information return, it's also important to estimate whether or not top-up taxes will arise. Because imagine closing the books for 2024 and find out an unexpected top-up tax.
Yeah, you are absolutely correct. It's all about modeling, forecasting what will be the impact of Pillar 2. And that's also important, because you want to know, do I need to make cash available in case any top-up tax will arise?
Yeah. And with that, I think this brings us to the end of our episode today. I hope we demystified some of the Pillar 2 obligations for you.
This was only a start. In the next episode, we will guide you through the technical details and strategies for a long and sustainable approach to Pillar 2.
Looking forward to it. Take care, and don't wait until the end of December with your preparations.